Hey everyone. So we're actually getting to my favorite section of our textbook today, part 6. And this is money and prices in the long run. So what chapter 16 and 17 are is it's a basic introduction into monetary theory. And monetary theory is the study and theory of how money and the monetary supply influences the overall economy and influences everyday life. And what you'll find is that perhaps more than any other subject in economics, this has had a dramatic influence on history, particularly at the economic level. So, to understand this, though, we're going to kick off with chapter 16, which is the monetary system. And this is going to introduce us to what is money. How does money operate inside the US economy? Who controls money? Who controls how much money is out there? Who prints? So, in order to understand this, though, we first off have to begin with what is money and what do we mean by money? Well, let's consider if money did exist. What that would leave us with is a system kind of like the barter system. And barter system is a system reliant on trading goods and services for other goods and services. And this depends on something called the mutual coincidence of wants. And that means that both agents want what the other has. So, for example, I'm an economics teacher, right? So, what this would require is if I wanted to bargain with, say, Zaxby's down the street, I would get in my car, I'd drive to Zaxby's, and I'd be like, "Hi, I would like a chicken." And Zaxby's would go, "Okay, what can you offer?" And I'd be like, "I can give you a 15-minute monetary lecture." And they would say, "No, you don't want that. You're not getting any chicken." So obviously, we can see that there is a problem with this. Money smooths out this process. So people that do want monetary lectures and studies in economics, they'll pay me to teach this. But individuals that want food are willing to pay restaurants for. So money smooths out the process. But before we get into that, we're going to explore a quick disaster. And this disaster, in order to catch this link, this disaster is the example of hyperinflation in Zimbabwe. There's an awesome video by Marginal Revolution. It's called Who Wants to Be a Trillionaire? I highly recommend you go to that video to understand how disastrous the consequences of bad monetary policy can be. So, what do we mean when we talk about the meaning of money? Well, basically, money is the set of assets in an economy that people regularly use to buy goods and services. Excuse excuse me. Basically, money is a medium of exchange, unit of account, and a store of value that is liquid in order to exchange for goods and services. And so, what do we mean by these four functions of money? Well, the medium of exchange is easy enough. This is an item that buyers give to sellers when they want to purchase goods and services. So, your US dollars, right, are a medium of exchange. When you go into a store and buy something, you give them cash, and that is a medium of exchange. Similarly, you can give them a check, which is also a medium of exchange. But money does more than this. As a unit of account, money is the yardstick we use to measure prices and record debts. So effectively, while we don't know exactly what the quote unquote value of something is, we do know the price of it. And the price, saying $20, means that it is a value of 20 increments of dollars, right? So this is like a measuring stick, but for value. And money can influence this and define this in multiple different ways, and it changes where you are around the world, right? It's a dollar. Like in the example of Japan, it is yen. So $20 in the United States would actually be 2,000 yen. Now, it also is a store of value. So, for example, an item that people can use to transfer purchasing power from the present to the future. Sorry, that's the definition. An example of this would be when you go, say, you mow a lawn on the weekend, you keep the money that you can't keep the value you have made by mowing the lawn, right? You have mowed the lawn, that is done, that is complete. However, when you're paid for mowing the lawn by whoever paid you to do this, you now have money reflective of the value you created by mowing their lawn. And that money allows you to save the value of the work you did in mowing the lawn to be spent at a future moment when you would like to. So in a way, money allows us to store the value of our labor in order to spend and use in the future over time. And finally, liquidity is a function of money, and this is the ease with which an asset can be converted into the economy's medium of exchange. So, for example, in the United States, the medium of exchange is a US dollar. US dollar is absolutely liquid because it's itself. However, checks are also liquid, right? Because you can hand a check to the bank and the bank converts that check into money. Very liquid. Similarly, you can sell stocks, and you can sell stocks fairly quickly. Again, is converting stocks into cash, which is liquid. However, other things are not easy to convert to cash. For example, cars, automobiles, right? That takes a while to sell and convert into cash. So it's not necessarily highly liquid. This brings us to kinds of money. You basically have two general types. The first and earliest kind of money was commodity money, and this is money that takes the form of a commodity with intrinsic value. And by intrinsic, what we're saying is the material used for the money has a value beyond its purpose as currency. The classic additions of commodity money are gold and silver, which you can immediately recognize, right? That gold and silver has uses outside of just being money. Silver is used for jewelry. Gold is used for conducting electricity, metal, jewelry, multiple uses. So basically, what we say is commodity money uses a commodity for the currency, which in turn has a use value beyond just being money. So something I recommend is check out the section Why Gold in your textbook. This is a fascinating explanation of why gold became so valuable to humans. To contrast this, though, we have fiat money. And fiat money is money without intrinsic value that is used as money simply because the government decrees it. US dollar is fiat money. It only has value because the United States says, hey, this paper. The euro is another example. That's what's used by most of the countries. The British sterling, which is the pound, called the sterling because you guessed it, originally it's sterling silver, and etc. So all the world's currencies are fiat money mostly. They only have value because the government has decreed. So what does money look like in the US economy? Well, simply put, you have different versions of it. You have currency, which is the paper bills in the hand of. So these are the actual green dollar bills that we carry around in our wallets or leave at home. Demand deposits, meanwhile, are balances in bank accounts that depositors can access onto by writing a check. And so demand deposits are basically immediately liquidity, and they're almost immediately money in a way, even though they're not currency, right? They're not a US dollar. The fact that you can write a check and spend a check makes it money. So just for contrast, let's look at the two measures of money in the US economy. We have two kinds of stock generally. We have M1, which is the combination of currency and demand deposits, travelers' checks, and other checkable deposits. So basically, we have $1,100 billion of currency in circulation, i.e., the greenbacks in people's wallets. And then we have other checkable deposits, travelers' checks, which travelers' checks have basically become non existent. Just a quick definition travelers' checks were checks issued by banks guaranteeing the value of money when people traveled abroad. And this was a way of getting around the fact that we have exchange. Today, banks largely just guarantee this. So you use your credit card, and that covers currency abroad and the foreign exchange. So travelers checks are kind of an old has been, but they do exist. And then demand deposits. Well, this is basically just your deposit in a right? This is your checking account in a bank, is a demand deposit. And so while it's not money in your hand, by using a check, you can instantly access that, or by using a debit card, you can instantly access it. So that factors into the money supply. These are basically things that you can immediately spend as money. Now, just an interesting thing I want you to notice here. How can we only have $1,100 billion of currency and yet 2,481 billion M1? How can we only have physically $1,100 billion and yet somehow already in just M1 we have more than that in money? We'll get to this in a second. To add to the confusion, let's focus on M2. We have savings deposits, small time deposits, money market mutual funds, and a few minor categories. This adds up to nearly another $8,000 billion. And so combining that with the initial 2.5, 2,500 billion, we basically have 10.5 or $10,500 billion of money in the market. That's a lot of money. And again, only 1,100 billion currency backing it. So how does this happen? Oh, real quick, one more thing I want to add though. M2 basically factors in accounts that you cannot spend but are almost instantaneously convertible to cash. So for example, your savings account, right? You can't spend your savings ATM card. You can't swipe it at a store, but you can log on your phone, transfer the cash from your savings account to your checking account, and then instantly spend it. So it's basically a checking account, right? It's almost instantly convertible. Similarly, money market mutual funds, you can almost instantly sell that money, make cash, turn it and convert it into cash. So this is M2 includes categories that are so highly liquid that they are almost immediately convertible to one deposit. So your savings deposit can very quickly be shifted into a demand deposit. Now, before we answer this mystery of how does currency multiply, we're going to focus first on the Federal Reserve System. And this is the group that manages the US monetary system. And they are the US central bank. And when you hear the Fed, this is often who's being referred to. And they're the central bank of the United States. And a central bank is an institution designed to oversee the banking system and regulate the quantity of money in the economy. Major players include the Bank of England, who manages the pound, the Bank of Japan, who manages yen, the European Central Bank, who is in control of the EU currency zone and the euro. On an interesting note, the oldest central bank in the world is Sweden's Riksbank, which was started in 1668. So central banking is a very old idea with a lot of precedent. Now, the Fed is organized. It was created in 1913 following bank failures in 1907. A fascinating note here, the reason the Federal Reserve was created was because in the midst of the 1907 banking panics and banking crashes, a guy by the name of J.P. Morgan single-handedly bailed out the United States. One man, one banker provided the funds to bail out a banking crisis. The president at the time, Teddy Roosevelt, realized that this is very problematic and realized there needs to be some kind of barrier forward. So when Woodrow Wilson eventually took over the presidency, one of the first things he did was he created the Federal Reserve as a way of stabilizing this and creating a new category that of our new financial entity and institution which could solve this so that the United States was never at the mercy of a single individual bank. Now, the way the Fed is organized is it has a board of governors. They operate in 14-year terms. They're appointed by the U.S. president, and they are confirmed by the Senate. This is an interesting balance because the Federal Reserve is actually the Federal Reserve is made up of member private banks. It is, yes, a federally sanctioned entity, and they are audited, and the checks and powers are by the fact that their members are appointed by the president, conferred by the Senate. So there's a check, a public check on it. However, the government does not have control over what the federal does. So the chairman is the head of this board, and he's one of the most powerful. In this case, he is one of the most powerful individuals in the world. It serves a 4-year term, and they're selected from the board of governors. Ben Bernanke was the head of the Federal Reserve Chairman board during the Great Recession. Janet Yellen is who succeeded him in recovery, and for a long time, she was the most powerful woman in the Today, Jerome Powell is who is the current board of governor. On an interesting note, Jerome Powell is actually an attorney. Almost always they're economists now, but Jerome Powell's an attorney. However, there's actually a very long history here that economics and law are very intertwined. Now, the BOC, or the board of governors in this case, determines the following. They determine the money supply, which is the quantity of money available in the economy, and they determine the money supply through monetary policy. And this is the setting of the money supply by policymakers. So how do they influence the money supply and determine it? Well, let's finish going through our organization. We still have the Federal Open Market Committee, which gets into how directly the Federal Reserve influences money supply. And so the Federal Open Market Committee is 12 members total. It's made up of 7 governors and 5 members of the 12 regional banks. And all 12 regional presidents attend the meeting, but only 5 can vote. With New York allowed a permanent seat because of its role as financial. On an interesting note, there gets to be some historical complications with this. But Federal Open Committee creates policy around open market operations, which open market operations purchase and sale of U.S. government bonds, and it is key central tool utilized by the Fed to manage the money supply. Thanks in the money supply, though. So now we're going to get into answering how did $1,100 billion of currency multiply into $10,400 billion of money? And the answer is simply because we don't operate what's called a simple case of 100 reserve banking. And what 100% reserve banking means is that this is the case in which banks never made loans. So reserve deposits that banks have received but not loaned. A 100% reserve banking then is all notes in circulation are held as reserves in the bank, i.e. no loans are made. So when you put $100 in the bank, that bank takes the $100, it sticks it in an account and says, when you want, here it is. Now, you can evaluate this through a T-table, which is an accounting table showing assets on the left, liabilities on the right, and is sometimes a balance sheet because liabilities must equal assets. So a way to think of it is a T-table shows that when you deposit $100 in the bank has $100 in assets, i.e. the cash put into the bank, and then they have $100 in liability, as in they owe you the $100 you put in. Now, money creation, though, it comes from the fact that we don't use this 100% reserve banking. We use fractional reserve banking. And fractional reserve banking is a banking system in which banks hold only a fraction of deposits as reserves. The reserve ratio is what determines this fraction. And so an example of this is that a 10% reserve ratio means that if you deposit $100 in the bank must $10 in reserves at all times. It then has the opportunity to take the other $90 you deposited and loan that out to someone else. So you can already possibly see where this is going. If the bank puts $10 and has $10 in reserves, and then has $90 left to loan, and it loans that $90, well, what does that mean about that $90? It's going to get spent, and it's going to go to another bank, and so on, and so on, and so on. But we'll explain this a little more in a second. However, on an interesting tidbit here, if you ever watch It's a Wonderful Life, It's a Wonderful Life gets at the problem of fractional banking, which we'll talk about it here in a little. Now, just to give you an example of the fractional reserve banking system, here's a simple example. If you have a required reserve ratio of 10%, and let's say someone deposits $10,000, you actually have new demand deposits of $100,000. What just happened? Basically, what we're saying is with a 10% reserve ratio, a $10,000 deposit will create $100,000 worth of new deposits. How does that work? Well, if we look over here, what we have is what we call the money multiplier. And the money multiplier is the amount of money the banking system generates with each dollar of reserves. Consider the example on the left. So what happened? How did we get from $10,000 deposit to $100,000 in reserves? Answer is with a 10,000% reserve ratio, 10,000 is initially deposit. Bank holds $1,000 in reserves and lends $9,000 out. Okay, that makes sense. When that $9,000 is spent, it winds up on another bank's account. That bank now holds $900, right? Because it's a ratio of 10%. $1,000 is 900, and they lend out $8,100, and so and so and so on. By the end, we can determine how much new demand deposits are by doing 1 over the reserve time. In our case, so let's zoom in. Because we deposit $10,000, we would do, and we have a reserve ratio of 10%, we would do over times 10,000, $100,000. So what this tells us is this equation here tells us the money multiple, tells us how much we are multiplying. It tells us how much we're multiplying the currency. What this 1 over 0.1 is the money multiplier. So note, the money multiplier is the reciprocal of the reserve ratio, i.e. it's 1 over the reserve ratio. So if we change this reserve ratio to 5%, this money multiplier becomes equal to, so 1 over 0.05 would equal 20. 20 times 10,000 would mean we $200,000. So again, this is just a complicated little measurement, but this shows how an initial amount of money, say $1,100, billion of currency can multiply to be worth 10.5 or 10,500 billion dollars of money. And it's through this multiplier effect from fractional reserve banking. Now, this has important complications. For example, bank capital leverage in the financial crisis of 2008. At the core of two of the United States' greatest financial crises has been money supply and things such as leverage. So what is bank capital? Well, bank capital is the resources a bank's owner have to put into the institution. So banks start by individuals putting up their own cash, and this is called their equity. So what do we mean by that? What we mean is that when you see a bank called Chase, right? Chase was started by a guy named Samuel Chase. Samuel Chase put up his own money and took out some loans. And this combination of his own money and loans is what he used to loan out money and fund the bank, along with other investors. Leverage is of borrowed money to supplement existing funds for the purposes of investment. And this gets us to something called a leverage ratio, which is the ratio of the assets to bank capital. So basically, if you wanted to start a bank today, so just for example, you wanted to start a bank today, what you'd have to do is you'd have to create an ownership group and you would put your own money forward. But inevitably, the amount of money you put forward would likely not be enough to actually run a bank, or at least run a bank competitively. And so without able to run a bank competitively, you would borrow more money to supplement your additional funds to create loans. The ratio between these, how much cash you have, i.e., the bank capital plus the leverage money combined compared to just your bank capital, tells you your leverage ratio. So for example, if a firm has $1 million in assets and only has $200,000 in bank capital, that means you have $800,000 of leverage money to supplement your funds, and that means you have a leverage ratio of 5-1. So for every $5 in the bank, one of them is a capital. Or two of them are capital. Sorry. The capital requirement is a government regulation specifying a minimum amount of capital. And so the government can set a standard that banks have to get around, or banks have to have a certain amount of private ownership of their total asset. On a fascinating note, what does that mean for banks like Chase and Wells Fargo, right, where they obviously don't have single owners? The answer is their capital, their bank capital, comes from stock issuances. So when you own stock in these banks, which we mentioned in chapter 13, owning in the firm. And so by owning ownership of the firm, that is part, you have invested in the capital of the firm. The long story short here is that the crisis of '08 is that banks were over leveraged, and when assets crashed, they became insolvent. There's a very long story here, and there's a great video again at Marginal Revolution University you can check out under their monetary section. There's a great primer and explanation for the origins of the financial crisis of '08. Now, beyond this, though, how does the Federal Reserve Act influence this money supply, influence the fractional reserve banking and monetary creation? We've already hinted at a couple of examples. We talked about the reserve requirement, which is the regulation on the minimum amount of reserve banks have to hold against us. And we also mentioned open market operations, which is buying and selling of government bonds. But there's a few other tools. The Federal Reserve can influence the quantity of reserves by also lending to banks and by setting the distance. And so the Fed can make loans directly to banks, and they do this with an interest rate, which is called the discount rate. And that is the interest rate on the loans the Fed makes to banks. So currently, the discount rate is 0%, which means that the Federal Reserve loans to banks at a no bid for. And that interest is, again, something that informs then the interest rates at which banks loan to each other and to customers. Now, beyond reserve requirements, the Federal Reserve has introduced another new strategy, and they pay interest on reserves. So since 2008, the Fed now pays banks interest for their reserves. This represents a key issue in lending. So in our reserve ratio in our earlier initial example, right, if you deposited $100 and you have a reserve requirement of 10%, it made sense for the bank to lend out all $90. Why? Because they don't make money to reserves. It didn't make sense for banks to keep cash on hand. It made sense for banks to try to move as much cash as possible. By now, the Federal Reserve pay interest on reserves. This circumvents a key issue, and banks now have an incentive to make sure plenty of necessary reserves because they are making money on. Now, in practice, things can get a little dicey. And to explore this, I'd love for you to go again to Marginal Revolution University and click on two videos. One is an explanation of how the Federal Reserve operated previous to the 2007-2008 recession. And the next video is a video at Marginal Revolution University that then explains how the Fed acts now post that recession. Both fascinating, important, and they explain how the Federal Reserve has evolved as a central bank and is more influential than ever on our financial markets. Now, with that, there are problems in controlling the money supply. And the reason there are problems in controlling the monetary supply is that ultimately confidence, or animal spirits, as Keynes put it, plays a huge role in the money supply. And what we mean by animal spirits is basically that since the Fed cannot compel banks to lend up to their reserve ratio, how much money banks hold in reserves is a function of their expectations for the economy. The animal spirits Keynes referred to is how confident banks are in lending. So in the United Kingdom, for example, there's no reserve ratio. The only thing determining the amount of the money supply is how confident banks are and how much they're willing to loan. So if banks feel confident and good, they loan out a lot of money. The thing is, when you loan out a lot of money, that leaves you at risk that if expectations turn sour, there can be a dramatic contraction in loans and money overall. Similarly, bank runs are a constant threat, and that is a part of the animal spirits as well. While we have wild periods of optimism, we can also have wild periods of negativity. And bank occur when the depositors fear the stability of the bank and all run to demand their deposit. Given banks operate on fractional reserves, they can't possibly meet all the demand, and the banks go under and lock people out of their assets until the Fed can sell those assets to a new. So today, when a bank goes under, the Federal Reserve buys a bank, it insures people's deposits, and then it finds a new bank to buy that bank and take over those assets. Now, if you want a perfect example of a bank run, again, I highly recommend go watch It's a Wonderful Life. The premise of It's a Wonderful Life is it's based during the onset of the Depression, and it is about a bank run. It's about a mortgage firm which sold farmhouse mortgages and house mortgages and tried to be an affordable lender. And the crisis happens, so the Great Depression happens, and his character, Jimmy Stewart's character, is trying to explain how fractional reserve banking works. It's a great scene. I highly recommend, and it shows the frustrations of the bank run. Additionally, we have a question of what happens if the Federal Reserve does too much. Again, Marginal Revolution University, fantastic video on this. Basically, the Federal Reserve can create tremendous problems. In the years leading up to 2007 and 2000, the Federal Reserve backed away from its obligation to responsibly manage the monetary system and kept interest rates far too low for far too long, leading to a crisis. Now, we also have a case study here. This video is called I believe it should be in your study notes. This is Anatomy of a Crisis and the Great Contraction, and it's by Milton Friedman. Milton Friedman won the Nobel Prize for his research on the beginnings of the Great Depression. And what Milton Friedman explored was how a contraction in the money supply over the course of the 1920s set the stages for the Great Depression. And great video, you only need to watch about the first 25 minutes of it, but I highly recommend checking it out. After that, read Ben Bernanke's exit strategy in your textbook, because Ben Bernanke, as the chair at the onset of the Great Recession, fought the Great Recession using much of the insights explored by Milton Friedman in this video. So this is wildly influential. It's a huge influence on how we explore and understand monetary policy today. Now, before we go, we're getting down to the final few slides here. The federal funds rate is another way in which the Federal Reserve influences the money supply. This is the interest rate at which banks make overnight loans to one another. So the discount rate is a loan from the Federal Reserve to another bank, but the federal funds rate is a loan from one to another bank, and it's a very short-term loan. So for example, we mentioned that banks have these reserve requirements. What happens if a bank gets a loan and makes a loan and is short of funds? In the short term, what they do is they take a loan out from another to balance out and ensure their reserve rate, waiting for the cash to come in from their loans, and then they pay back that loan. It basically allows banks to keep within the government's regulations, also having the flexibility to wheel. Now, it's important for two reasons. Ultimately, the baseline interest rate on top of the Fed's discount rate, which informs other interest rates. So, how much banks are loaning to each other informs how much banks are loaning to you. Every 6 weeks, the Fed sets a target FFR and adjusts monetary policy accordingly, affecting the money supply and correspondingly inflation. Now, one of the things that has been a concern here, and again, the Marginal Revolutionary University videos will discuss this as well, is there are questions that if the Federal Reserve does too much and can create damage, should that we leave the money supply to independent bankers that are accountable to the public? And so there's a debate of rules versus discretion. And the idea of a rule is that you force the Federal Reserve or compel the Federal Reserve to expand the money supply in a prescribed. While discretion argues no, the Federal Reserve and its board are experts, and we should allow them the judgment and decisions to make the right call. Inflation targeting is one of the compromises between these two philosophies, and inflation targeting is basically a strategy in which the Federal Reserve uses the federal funds rate as a way of gauging and setting inflationary. We'll talk about this in chapter 17, why these two are connected, but basically, by setting the interest rate and setting the expansion of the money supply, the Federal Reserve has an ability to influence what the inflation level will be. And with that, we're going to pause today and leave it off, and we'll pick up next in chapter 17, money growth and inflation.